The World Bank says rising food and fuel prices and supply chain disruptions worsened by Russia's attack on Ukraine are taking a devastating toll on the global economy. It expects global growth to slow significantly from 5.7% in 2021 to 2.9% this year. Officials say that rate could drop even lower if supplies of grains and fuel from Ukraine and Russia don't normalise soon. Developing economies are likely to face the brunt of this slowdown. The World Bank says some of them are at risk of severe recession not seen since the 1970s. And a quick rebound seems unlikely. The Washington-based lender says the world's GDP growth will likely fall even lower to 1.5% next year.
One issue is, of course, the intensification of geopolitical tensions. It has implications for commodity markets. Another one is the faster than expected tightening of financing conditions because of policy interest rates going up and COVID-related disruptions. When you put three of them together, if those three risks materialize, we can easily find ourselves in the midst of a perfect storm. That type of storm will push growth rate this year to 2% and next year at the global level 1.5%. And when you have growth rate at the global level around 1.5%, that means you are in a very serious, severe downturn.
Now, as business activity slows, central banks usually ease their monetary policy, offering cheaper loans to encourage investments and spending. But persistently high commodity prices are forcing many economies to focus on reining in inflation. The European Central Bank is ending its bond buying program, effectively restricting the supply of euros in currency markets. It also aims to begin raising interest rates from July for the first time in more than a decade. The Bank of England has hiked its benchmark rate 4 times in 4 months, driving it to the highest level in 13 years. And the US Federal Reserve has been increasing borrowing costs since March. Officials there say they'll stick to a tighter monetary stance in the coming months.
We currently face macroeconomic challenges, including unacceptable levels of inflation. In the administration's fiscal 23 budget, we suggest smart, fiscally responsible investments, cutting deficits and keeping the economic burden of debt low. The budget's investments are more than fully paid for through tax code reforms requiring corporations and the wealthiest Americans to pay their fair share, closing loopholes and improving tax administration.
Well, let's get more on this now with economist and Professor Joanne Weiner, the director of the Applied Economics Graduate Program at George Washington University. Really good to have you back with us, Joanne. Can I start with the latest inflation figures coming out of the United States? So 8.6% in the 12 months to May, the fastest pace in consumer price rises in 40 years. What's the main driver of this? Is it just rising petrol and energy prices?
Yeah, those are pretty harsh numbers. When you have inflation higher than it's been in 40 years, we can no longer be saying that it's temporary or just wait. It's not as bad as it could get. Yeah, much of the increase is by fuel. The average price of a gallon of gas in the U.S. is over $5. That's something that we haven't seen before. And food prices are rising in part due to global uncertainties. The Russia-Ukraine war is not helping matters with food or energy prices. But it's going to be tough. Inflation rose faster than expected, and that's bad news.
Now, the World Bank says with inflation now running at multi-decade highs in many countries and supply growth expected to just creep up slowly, it expects inflation to persist for some years to come now. So is this just a supply issue then, the fact that the production of goods can't keep up with demand across the globe? How do you fix that?
Yeah, well, supply is clearly a big problem, and that's been true since the pandemic started. Everyone knows about the supply chain crisis that factories have shut down due to the pandemic, and countering that, though, is that demand is up as well because of the stimulus payments that came out a couple of years ago. We had a very, very short recession in 2020. in part because of the government spending. But I think in the U.S. at least, it's now coming home that excess demand and limited supply is both of those factors are driving prices up, and it's hard to see where it's going to end, at least in the short term.
Now, the World Bank is also warning of potential stagflation. This is when prices keep on soaring, but economic growth, as we know, continues to slump. Are you worried about stagflation as well?
Well, I would have been if we were back in the 1970s, but I think the Fed learned a lot from the 70s in terms of how to respond to. Well, in that case, it was a big oil price shock that drove stagflation. I think the Fed is going to have to raise interest rates, maybe much faster than it would have to do, and we're already seeing signs that they do anticipate. Tightening up faster and sooner than they thought they would. So that I think the Fed is smarter now than it was 40 years ago in terms of how to respond to inflation to prevent stagflation. No one wants that, the wage price spiral.
Yes, and of course, the flip side to this monetary policy remedy, the raising of interest rates in the US and around the world, is that obviously growth will slow as consumer spending is expected to slow as well. Do you believe this is the main course that central banks around the world should be taking right now?
I think so. I think that we want consumers to keep on spending because we want to keep the economy growing, but we don't want to do that at the expense of having inflation that gets out of control. And when you think back to the 80s and 70s when we had double-digit inflation and unemployment, that was bad. Unemployment is very low these days; it's 3 point some percent in the United States, so that's good news. But real wages are not rising because inflation is growing faster than wages are. So the economy's not looking so great, but I don't think we're in the 70s, and I think that the Fed will be able to at least keep the worst from happening. Let me put it that way.
I'm going to ask you now to do a bit of crystal ball gazing. How much longer do you expect these economic conditions to persist?
Well, there's no change on the horizon in some of the things that are driving prices up. The only thing that could help it get back on track would be to have the supply chain blockades begin to loosen. And it takes a while to build factories. It takes a while to get those supply chains put back together. So I think we're going to be for maybe a long, hot summer.
Okay, Joanne Weiner, always a pleasure. Thanks very much again for joining us on Money Talks.